crack on. We're recording already, so might as well just get it started. So we're doing another episode of the Haugen Patel Value Investing Show. Yeah, should we just jump in? Oh, before we do that, do the obviously I'm Lars Haugen, says that on the thing. Roshni Patel. Follow us on.
Yep.
You can see our website, hpvalueinvesting.com, our eToro page, our YouTube page, all that good stuff. You know, like and subscribe, etc., etc.
So our most recent investment was it maybe a couple of weeks ago, was ASOS. For those of you who are not in the UK, it's a really huge UK-based online fashion retailer. They don't just do clothes, they also do cosmetics, and their targets are the 20-somethings market. The company were founded in 2000, they're headquartered in the UK, and they're really big on the online fashion scene.
If we look at the PE ratio, it's been quite up and down, but we tend to see. Sorry, I'm just looking at my screen right now.
I'm looking at my phone, so if I'm looking down.
Yeah, so we can see that the PE ratio is kind of historically over the last 15 years. The lowest it got was around the 25 ratio
just
area. So it was so even in 2008, 2009, like at the bottom, it was like around 25, and then only in 2019, when they had some issues that you mentioned, that it went down to around 21, 22, and then right now it came back to that level as well. So we thought that this could be a good time to, or you can't just make an investment based on PE ratio, but it's kind of, it piqued our interest. And you know, while 22, 21 is not a low number, the company's growing so much that it kind of, if it keeps growing, it will kind of make up that in growth. We think ASOS is a quality company trading at a reasonable price, and that's kind of, you know, the typical thing that Warren Buffett looks at. So we kind of just stole that idea. And you know, the reason why it's a quality company is that it has a strong brand name. It's run by honest and competent managers. In our view, the return on equity is high, and the revenues are growing quickly. And you know, the industry is also growing, especially the fast fashion industry and the online only fashion industry, and the balance sheet is strong. And we also believe that they have several competitive advantages and healthy levels of free cash. So that combined with the thing we just talked about, you know, the valuation, the PE being quite low, the price to sales is also quite low. We can throw up a chart of that. So given that, we thought this was a good time to invest. We thought the valuation looked attractive, and we can talk a little bit about the valuation. So that's kind of the summary of the investment analysis, so people have an idea of why we invested.
So moving on to the management, what I was quite impressed by was how candid they are. So back in 2019, their results were poorer than expected, but they addressed that very openly within their report. They used wordings at the beginning, such as, you know, we've had disappointing results. And I just like how straightforward they were. There was no BS. They also explained themselves. So in short, their operating expenses were a lot higher than expected. They experienced more challenges in expanding their infrastructure, and they admitted that. So I found that quite impressive. So that's kind of one example of how I think the management, they're open, they admit their mistakes, and they also said what they were going to do next to kind of move forward, learn their lessons. And when I had just on a side note as well, their structure seems quite straightforward, or not straightforward, but their strategy seems quite sensible. That 2019 they lost focus on their core business. They lost focus on their customer engagement. So what's one of their strategies? They're going to focus more on their customer engagement. So I think that's, you know, quite sensible. And they also said they were going to reshuffle their team and also remove non-growing parts of the business. So I think having a cross restructure is also quite sensible. That's what I wanted to say with regards to the business.
that being said, we can move on to just competitive advantages, because I think ASOS has several competitive advantages. I mean, I can throw up a chart here, but in 2020, it's a list of the online fashion retailers, the biggest one, ranked by annual sales, and ASOS is number 5. So obviously, in this industry, the brand name and the size matters. ASOS has built itself to be one of the biggest brands in the world within this industry. So that is a competitive advantage in itself. So that's the one thing, the kind of the size, and obviously being, when you want to ship all across the world, it's important to have a large business to be able to deal with all those logistics. That's kind of the first competitive advantage that we highlighted. The second one is that they're very social media savvy. They have a big social media presence. They have 12 million followers, and from what we read, 12 million followers on Instagram. And from what we read, they're quite good when it comes to promotion on Instagram. And we all know that the 20-somethings, they spend a lot of time on Instagram, and they will see these the posts that ASOS does on Instagram. So obviously that it's kind of like a new way of doing marketing. So I think it shows that they're very in tune with their customers, and they're targeting the customers where the customers are. So I think that's just kind of that's a very important thing in this day and age. I think a third point is that they're very known for they're supposed to have good customer service. Now, I've never shopped at ASOS, so I don't know. I don't have an experience myself, but they kind of have this idea where, or they have a membership where you can pay $19 a year and you get free delivery throughout the year. So that's a very good example of how they spend money to invest in the customers. A few more things here on the competitive advantages. I mean, their size is a competitive advantage. I already mentioned that, but basically ASOS is a platform. So they have their own brands. They have other brands like Adidas and Nike and all that sort of stuff. So you have a huge platform where you have your own brands and other brands. I think there's something like, isn't it something like thousands of brands on there? And then, so the customers can choose between thousands of brands. And so the brands want to be on the platform, and the customers also has access to kind of all these brands in one place. So it's kind of where the sellers and the buyers meet. So the bigger that platform gets, the more valuable it is, and the more data is around there, so they can make it more tailored to the customer. So ASOS isn't just a fashion brand. It's like it's kind of like a tech company in a sense. When we look at industry analysis, we're looking over the next 10, 20 years. Is this industry is it gonna be bigger or smaller than it is now? So we don't focus too much on the dynamics or what's going on at the moment. We're looking more at the kind of compound annual growth rate over the long term. And the first thing I found is that there's a website called Statista that has a lot of good statistics. And I found, I could throw this up as well, but it said that the global apparel market is expected to grow from 1.5 trillion in 2020 to 2.25 trillion in 2025. So, it's expected to grow. That's global apparel. And then there's also a report from something called Research and Markets. And it says that the fast fashion retail market, which is the one ASOS is in, is expected to grow at a 7% compound annual growth rate from 2020 to 2025. So that's another kind of indicator that the market is still expected to grow. And we also found a report from McKinsey, which is the 2021 State of Fashion report. And it says that the pandemic will accelerate certain trends. So it's becoming more digital. And it's also, people are caring more about kind of fairness and social justice. And as we just mentioned, ASOS is completely digital, and they kind of also clued in on what their customers care about. So this whole social justice kind of thing, and being environmentally friendly and all that sort of stuff, that ASOS is very clued into that. So actually the report from McKinsey mentions that e-commerce players have kind of won out during the pandemic. So you saw, and they mentioned by name ASOS and something called Farfetch UK, Revolve, Zalando, and they have consistently outperformed in 2020. I mean, with that said, we can move on to the financials. I think maybe not getting too much into the weeds here, but just mention a few things.
Yeah, so we'll throw up the charts on the screen as we go through this, but you start to look at the margins and you see gross margin is above 40%, and that's fantastic. But then when you go to see the operational and then just the bottom line profits, the margins are quite low. The low margins are an example of scale economies shared. And what that means is any benefits generated as a result of economies of scale, they're shared with the customer, and in return, we get more more revenue. I think that's the approach that ASOS has been going for here. And I don't have a chart for the return on equity to hand right now, but in short, the return on equity is looking strong. That's something that we care about. We want to make sure that the business is generating some sort of return on the actual equity on the balance sheet there. And then one more thing that I wanted to mention here was that ASOS, they don't appear to have taken, looking at their financials, they don't appear to have taken debt until the last few years as well. And that was something that's quite impressive as well.
So I think we can start to kind of to wrap it up here. I think just we should mention a bit about the valuation. We won't go into too much detail, but basically we tend to look at a combination of free cash flow, and then or free cash flow is one thing, and then we look at the operating earnings, and then we look at the net profit, and then sort of do a discounted cash flow or DCF on all those. And because we get three different ones, we can look at it from different sides. So if what we found for ASOS was that the estimated fair value is in the 42 to 43 pounds per share range, and we bought shares at around, I think, 38 pounds per share. But we used a lower growth rate. We used a growth rate of 15% per year over the next 10 years, and then after that, for the 10 after that, 5%. But just to put some context around it, over the last 10 years, both the operating income and the net income has grown at a compound annual growth rate of about 22%. So that's 22% every year over the last 10 years. So we used a little bit of a more modest growth rate, and we still found that there was still a margin of safety. I think that kind of summarizes the valuation. I mean, I guess we can just mention some risks because that's important, and then the conclusion. So just in terms of risks, from my point of view, what I highlight is that, I mean, we mentioned earlier, if there is a more of an economic downturn coming from the pandemic, then obviously people won't have as much money, especially young 20-somethings probably. And also clothing is kind of like, especially fashionable clothing, going out clothing is a discretionary expenditure. So that'll probably be cut if that happens. And then, I mean, there's obviously competition. There's, Amazon is moving into the fashion space. Zalando is a very big one. It's actually bigger, quite a lot bigger than ASOS in terms of revenues. That's kind of something to keep an eye on. And also the fashion trends. I mean, the fashion industry is very fast moving. There, trends are going in and out. So it's kind of, you never know. Like, for example, with Topman that you mentioned earlier, that went out of business. Like, that was like the hottest brand a few years ago, and suddenly they're out of business. Now, that might be a bit more to do with how they ran the business, but still, like, you see these big old brands suddenly going out of business. Now, obviously, we don't think ASOS is in that same category. We think those are the ones, that's the type of company that will do well. But I mean, you never know.
That's still a risk though, isn't it? It's still a risk.
Exactly, it is still a risk. And just one last thing on the risk that I mentioned, like Amazon and Zalando. Like, obviously, there are risks, especially if Amazon is moving. Whenever Amazon does anything, you kind of have to pay attention. But I think from what I read, that Amazon was kind of focusing a bit more on different a different target market, maybe more like a your essentials when it comes to fashion, you know, your jeans and your socks and all that sort of stuff. And they don't have nearly as many followers as ASOS does. So I think Amazon is kind of, when it comes to like fashionable going out clothing, I don't think like a 20-something woman will go to Amazon. I think they rather want to go to ASOS, because ASOS only does fashion. They're very good at it. So I think they already have a leg up on Amazon there. And obviously Zalando is another one. I think that's bigger in continental Europe. I don't think it's not that big in the UK, and maybe not worldwide either, but they're a threat. Like they do kind of the same thing. I think they focus a little bit more on potentially the older market, and it's a different geography. But still, I mean, I think it's a fast growing industry, and they've both been very successful. There is room for both. That being said, moving on to the conclusion, I think I just go back to what we mentioned in the beginning. I think it's a quality company trading at a fair price, and that's why we invested. It has a good brand. It's, you know, it's a massive company. It's a good platform. There's social media savvy, good financials, good you know, the industry is growing, competitive advantages, strong balance sheets. So what was that?
Candid management as well.
Exactly. Yeah. Exactly. So I think and it trading at a price that's below our estimate of fair value. So I think all that kind of coming together, I think that that's why we invested. And I think that's kind of summarize it. And again, thank you to everyone for watching or listening, and you know, like, subscribe, share it, all that sort of stuff. Check out eToro, our website, hpvalueinvesting.com. And I think that's it. All right. Thanks, everyone.
All right, so till next time. Bye.
Bye.